For a long time, the ultimate goal of the salaried worker was simple: protect your hard-earned income from taxes and do it using government-backed schemes you knew were safe. The main tool for this was Section 80C of the Income Tax Act. It shielded up to 1.5 lakh rupees of your yearly income right off the top. And the undisputed king of the 80C era was the Public Provident Fund, or PPF. PPF was popular because it held what's called an exempt status. Your initial deposit was tax-free, the interest it earned over the years was tax-free, and when you finally pulled the money out, that was tax-free too. But that level of ultimate safety came with a heavy cost. You had to lock your capital away for a strict 15 years. For decades, investors looked at that trade-off and accepted it. Giving up access to their money for a decade and a half made sense if it guaranteed absolute tax-free security. Eventually, mindsets shifted. People started looking at the stock market and realizing they wanted higher returns, even if it meant taking on a little more risk. That's when equity-linked savings schemes, or ELSS, became popular. These are mutual funds that invest directly in the stock market, but they still qualify for that coveted 80C tax deduction. This chart explains the jump. Instead of PPF's 15-year lock-in, ELSS locked money for 3 years. PPF historically returned 7 to 8%, while ELSS offered 12 to 14%. Then, the new tax regime wiped out all Section 80C benefits. Taking away that tax deduction broke the specific mathematical advantage that made ELSS such an automatic recommendation for the salaried class. Some legacy planners have actively chosen to stick with the old tax regime to keep claiming deductions. For this group, the core decision is still a direct battle between PPF and ELSS. This matrix breaks down the trade-off. ELSS withdrawals face a 12.5% capital gains tax above a 1.25 lakh limit, while PPF keeps its EEE status, meaning zero withdrawal tax. For returns, PPF gives a fixed 7 to 8%, while ELSS offers a volatile 12 to 14%. The only way to justify choosing ELSS here is if the compounding power of those higher equity returns outpaces the 12.5% exit tax you'll eventually pay. Under the old regime, if you accept the market risk and plan for exit taxes, ELSS remains a strong vehicle for aggressive wealth generation. But if you are a modern earner who has transitioned to the new tax regime, the rules are completely different. Under this new system, depositing money into PPF or ELSS yields absolutely zero upfront tax deductions. You have to ask yourself why you would willingly trap your own capital in a 3-year lock-in if the government is no longer giving you a tax subsidy to do so. The alternative is to move to normal mutual funds. These standard funds offer the exact same equity market exposure and the exact same 12 to 14% return potential as an ELSS fund. The major advantage is immediate liquidity. There is zero lock-in period. Withdraw your money whenever needed. The one behavioral trade-off is that without a mandatory lock-in, you lose the forced saving discipline. You have to actively choose not to touch the money. Choosing ELSS in the new regime means accepting severe liquidity restrictions for absolutely no financial benefit. Normal mutual funds are the objectively better choice here. Looking at this decision flowchart, we can remove subjective opinions completely. Your correct investment vehicle is dictated entirely by one question: which tax regime are you in? If you are in the old regime and want to protect your capital from market swings, you route your money to PPF. If you are in the old regime but want higher wealth generation and accept the risk, you go with ELSS. But if you file under the new tax regime, there is a direct, unbroken path to normal mutual funds. Do not fall into the outdated advice trap from peers or family telling you to buy ELSS. Investment products aren't universally good or bad. Their financial viability is strictly tied to your specific financial context. For those of you moving your capital into normal mutual funds, that new liquidity brings a new set of evaluation challenges. Now that you aren't restricted by a lock-in, you have to look closely at expense ratios and exit loads. Escaping the ELSS lock-in trap is pointless if you immediately lose a chunk of your capital to hidden fund management fees. Optimizing your tax strategy is step 1. Step 2 is optimizing the fees on your liquid